Alright, in this video, I will be going over my updated risk management guidelines for my trading. I've made a video like this previously, but I have, added some things. I think I've cleared some things up in terms of the rules that I follow, so I figured it was worth it to make another video. And we are going to start off with percent risk per trade. Now, the way I calculate this, or the way I, basically do this, is I risk a certain percent of my total trading capital. So I usually have my trading capital spread out on multiple exchanges because I like to have multiple trades open at once. I like to be able to open one trade, TP on it, lock it in, hold that trade. Usually I'm trading Bitcoin, so then I'll wait for another setup and maybe I'll open another trade on a different account while I still have that previous one open. And I also don't keep all my trading capital on exchanges. I keep a good amount of it on hardware wallets as well. That's a joy of using leverage is you don't need to keep all your money on the exchange and have it at risk of being hacked or getting FTX'd. And I risk a minimum of 0.25% of my total trading capital per trade and a maximum of 3% per trade. 0.5 or half of a percent is typical for scalps or reaction trades. Those are going to be, my lower confidence trades, the trades that I, am less patient on. I wait for less confirmations, and I will risk a maximum of 1% on these type of lower confidence trades. A 1% risk is typically for higher confidence day trades. So high confidence, also not exactly like a scalp. I'm not looking on the 1 minute. Maybe I enter on like the 1, the 2, the 3, the 5, but my overall idea is based on, the more midterm time frames. And I will risk a maximum of 2% of my trading capital for those kind of trades. And a 3% risk on one trade is for the rare high confidence, high time frame trades, which, again, sometimes I may enter those high time frame trades on a lower time frame. Maybe I'm entering them on the 30, the 15, the 5 minute. But if it's based on a high time frame, if I have high enough confidence in it, then I may take a 3% risk on it. And next, we are on to cutoffs. Now, this basically means, all right, when do you stop trading? When do you stop taking trades after you've taken a few losses? And this is pretty much the new addition to my risk management guidelines. I added a few things into my cutoffs, specifically how many trades can I take to try and capitalize on one overall idea before I consider that idea kaput. And my cutoffs are a 1% total loss for one lower confidence scalp idea, which means that, if I take a 0.5% risk and I get stopped out immediately, I can technically take another 0.5%, risk a total of 1%, which matches my risk management for a scalp idea over here, a 0.5% per trade, a 1% max for these type of trades. And if I lose a total of 1% on a lower confidence scalp idea, I'm done with that idea. I don't care if it continues to play out after it just stopped me out. I'm not re-entering. I will only take a 1% loss on, a low confidence idea. I will take a total of a 3% loss on one high confidence trade idea. And, to clarify, this is for when I take multiple low time frame trades to play into a higher time frame idea. And again, this matches my risk management for those higher confidence ideas. I can take 3 1% trades. I could take, 1 2% trade and maybe 1% trade. And if I lose both of those, all right, that's a total of 3%. I am done with that idea. I'm no longer trying to trade that idea. Those are basically the two new additions to my risk management guidelines. Now, this is something that I've kind of always practiced, but, I haven't really put it into writing and put it into my actual risk management rules. So, now I have. And next we have the per day and per week cutoffs. So if I take a 5% total loss in a day, I'm done trading for the day. I will wait until the next day and I'll look for, fresh new setup. I'll look at a fresh chart. I'll look for new setups, new ideas. This kind of helps prevent a downward spiral because, I know as well as probably most of you know that once you take a loss, you are more susceptible to taking more losses, especially if you let those losses get to you and mess with your mental. And if I take a total of a 12% total loss in a week, then I am done trading for the week. Now that could be 2.5 days into the week. Maybe I take a 5% loss the first day, a 5% loss the second day, and then the third day I managed to just squeak out a total of a 12% total loss. All right, well, I'm done trading until next week, until the next weekly candle opens, and probably until at least Monday, maybe even Tuesday of the next week, so I can try and get the best trading conditions. And the good thing about following these risk management rules, the risking 1% or 0.5% and 1% total on lower confidence ideas, 3% total on high confidence ideas, usually these rules allow me to not have to reach my cutoff points for a week of trading or a day of trading, because it's not typical that I lose that many high confidence trades in a row where I'm down 5% for a day or 12% for a week. It has not happened in a long time, but those rules are there for if and when it happens again, which I would be willing to bet that at some point I will take a 5% loss in a day or a 12% loss in a week, and when that happens I need to cut myself off. All right, now on to some other risk rules. The first trade of each day should be a high confidence trade. I don't want to start the day off taking a low confidence trade that, there's a pretty good chance that I lose it. You don't want to start the trading day off with a loss. And so why risk putting yourself in that situation where you're starting off the day down when you can just wait for a high confidence trade? Now, sometimes that means that you don't take a trade in that day, which is fine. I'd rather not take a trade than take a loss or two trying to trade some stupid idea. And I should only take lower confidence trades, which are scalps, reactions, trades with poor confirmations, etc., if you already had a profitable trade for the day. Essentially, I want to be trading with house money if I'm going to be taking a stupid trade that may lose or may win. And that is a rule that has helped me to avoid a lot of losses because I am focusing on the higher confidence ideas. If I locked in, I don't know, 2% for the day on a higher confidence trade, then I can afford to risk maybe, one quarter of that 8.5% risk on a scalp to potentially make, I don't know, another 1.5 to 2% if I get like a 3 or 4 risk reward out of it. So that's kind of my logic here. If I'm going to be taking a lower confidence trade, and if I'm going to lose that trade, it should not put me in the negative for the day. I should still be profitable for that day. And the only exception is if you are up significantly for the week. So, if I'm up, I don't know, 5% for the week, maybe I can risk, 10% of that, a 0.5% risk on a scalp, and that's no big deal. And additionally, after 2 scalp losses, which should equal a total of a 1% total loss, stop scalping. The next trade must be high confidence. And finally, my profit management rules. This is just as important as my risk management rules, I feel. So first, for scalps or reaction trades, these trades should have very local targets to TP and de-risk. Typically, I aim for a 2 to 3 risk reward. If I'm taking a reaction trade or a scalp trade, typically I have a very small stop loss. So, I could get stopped out very quickly, or I could hit my targets very quickly at a pretty good risk reward. And my goal is to close a significant percent of these trades at very local targets. It's hard to see that, but that is 1/3 or 1/2 of my total trades. So if I'm at a 3-to-1 risk reward and I close 1/3 of it, then I just locked in what I risked. If I close half the trade, then I locked in slightly more than what I risked. And prioritize de-risking and locking in a small profit before looking for further targets. My first goal with every scalp is to not lose the trade. So I'm looking to de-risk as soon as possible, even if that means that I'm de-risking the trade, putting my stop loss to entry before I actually take profit, before I hit my 2 or 3-to-1 risk reward target. First priority is de-risking, then second priority is locking in a small profit, then third priority is looking for further targets to lock in more profit. High confidence trades should have strong confirmations, giving you high confidence in your targets, unless an equally strong confirmation of invalidation, and that is a weird way to phrase that, I know. Really, what I mean for this is a confirmation going against your trade. And if a confirmation going against your trade is presented following your entry, then maybe you look to TP, earlier than you expected, or de-risk earlier than you expected. But if they're not, so unless an equally strong confirmation of invalidation is presented following your entry, you should look to hold these trades to or close to your targets to try and prevent TPing too early when you have a good trade. And that can be a very difficult thing to put into practice. It's taken me a long time to really feel confident in my ability to determine when I should cut a good trade out early. But I have been doing this for a pretty long time, and I have a pretty good bearing on when I should consider a high confidence trade not high confidence anymore. And that is pretty much it for my risk management rules. I have my percent risk for trades, my cutoffs, my etc. risk rules, and my profit management rules. And, there may be some other rules that I follow that I forgot to write down, but I think these are all the important things right here. All right, that does it for this video. Thank you everybody for watching. If you enjoyed, consider leaving a thumbs up, consider subscribing to my channel, consider leaving a comment. I really appreciate all the support that I get on my channel. It helps my channel grow. I appreciate it. And I will see you all in the next video.